many did the problem? You know the simple little problem I gave you? Just 1 through 11, led you through it. How many did that? Oh my. Well, for next time, you know what you're going to do? You're going to value, you see that on the cell list there? You're going to value Yum, I think, and Target. And I'm going to ask you for your values. That's Wednesday. And we'll go around the room and we'll ask everybody to tell us how much they think each of them are worth, both of them. So now you need to read the chapter if you have it, or read the paper if you have it. Okay, it's short. And it's pretty straightforward. I hope I try to make it as simplistic as possible. Just say it, right? Just said it, but it's packed with information. Read it. That's true, isn't it? There's a lot there. Get a handle on it with the idea, and we'll talk about it today. And then you need to work to the sample one so that you can try one. And then we're going to try valuing real companies. You're going to go out online and look up Yum and look up Target. You can find them in Yahoo Finance, MS Finance, whichever one you want to use, whichever server you want to use. And you can find all kinds of information on it. And maybe today we'll get some time to go out and look at something, show you where to go. But you guys know how to surf the internet, don't you? Yeah, that's all it is. And then you go find the real financial statements at their site. Use the real financial statements. Don't use the ones that are out of Yahoo Finance or MS Finance. Because what they do with those is they summarize them. And I swear they have a minimum wage high school kid summarize it for them and put them all in categories. Because there are so many mistakes. Not always, but usually there are mistakes. And besides that, they group things in categories that make absolutely no sense. Because they're trying to make every financial statement look like every other one. Use the real statements. They have the real ones out on the web pages, or out on the websites for the company. Yeah.
Okay, I was just asking which one, because I didn't hear what you said, which one was for like representation.
Don't use the financial statements that are included in Yahoo Finance or MS Finance. Go to Yum's page and find their financial statements there. The ones they file with the SEC. Or go to Target's in there. Any publicly traded company, they always put it out on their own website. And they're real pretty and easy to read and usually easy to navigate, find your way around it.
So like when you're looking through Yahoo, like going through each company, you can pull up additional data and look up their income statement.
Exactly. Don't use the income. You can, but there's too many mistakes in it, I think. Okay. And it's summarized in strange ways a lot of times. So some people do that, but I think it's a lot better to get a real statement. Right?
I noticed
they have real ones. Why not look at the real one? Right? They're long, but you can find what you want in it. You just search for the balance sheet, income statement, cash flow statement. You're there. And then the notes are right there too. If you want to read some of the notes, get an explanation of what you're working on, right? Things you don't understand in the financial statements. Yeah. So why not have the real one? Used to be you had to order them from the company to get them. So you got any more, do you? So, did I give you your credit? I thought about giving you your credit. Do it. Okay. So where is this thing on whack tapped in? I'd like you guys, this is a finance model, right? It's a finance model. It is the basic model that people use to value businesses. The basic one. And then you can get as complex as you want. But all sorts of bells and whistles attached to it. My personal belief, and Dan Bauer and Brad Stevenson, the finance professors here, our belief is, and Richard Schrader teaches this stuff too, our belief is that you might as well keep the model simple because there are so many assumptions in the model anyway. If you make the model more complex, you just add more assumptions. And all the assumptions, you have to take the crystal ball out and decide which assumption is the right assumption. That makes sense? So this is really an art coming up with this. Yeah?
I was reading something, and they said that a lot of companies use discounted cash flow.
That's what this is.
That's what I was
Exactly what this is. That's a great question, actually a great observation. Comment. What is anything worth? If you get run over by a truck when you leave here today, what's your family suing for, guys? The discounted present value of what? All your cash flows for the rest of your life. That's what they want. You can't sue because it's painful to lose your child. Right? You don't get that. Okay? And you can have punitive damages if somebody ran over you on purpose. So, if it's an accident, right? If it's an accident, they weren't negligent, it just happens. They'll sue for what? The discounted present value of everything you're going to make for the rest of your life. I already pointed out to you because you're sitting in this class, you're worth more than before you started this class. It's true. And I'm going to tell you we're making an A, okay? Oh, yeah, they won't ask me. Okay? Don't worry, I don't have a lot. Okay, anyway, Somebody might think it's anything, I don't know. Anyway, so we will we'll value every company this way too. What do companies pay out? What do you get out of a company? You invest in a company's stock, what do you get back? Dividends and anything else? Oh, stock goes up. Either increase or decrease in stock value, you get that too. True? And here's the deal, you don't have to sell it to get it. If you buy a share of stock for $10 a share and it goes up to 12 at the end of the year, if you decide to keep that stock, you have reinvested $12. You have $12, you could have sold it and gotten it, right? So you have that increase in value. You do, right? You're deciding not to leave 10 there, you're deciding to leave 12 there, going up to 12. If it goes down to 7, right? You lost the 3, you did. Whether you sell it or not, you lost it that particular year. Now you don't have tax implications of the gain or loss, right, obviously, unless you sell it. Does that make sense? Okay? So I'm going to have to close that. It's kind of blinding today. First day of that. Sorry, guys. I'll turn the light on. There you go. Sorry. Okay, anyway. So if you think about this, you're going to get dividends and you're going to get stock appreciation or depreciation over the life of the asset, right? So if you were going to value a share of stock of a company or the whole company, what would you do? You should take all their dividends and the change in their market value of their stock forever, right? And discount it back to now. That's one way. It's called a dividend model, okay? You can do it that way. Or what you could do is you could say, well, you know, really, their net income, cash flows coming from net income, is what they have available to pay dividends with and or have the stock increase in value with. Does that make sense, theoretically? So what you could do is you could take their income and convert it to basically cash basis income, right? And you already know how to do that with a cash flow statement, don't you? Right? The basic idea. So what we could do is we could figure out what the cash flows are coming from the income, and we could discount all those cash flows forever back to now. That's what this model does. Been around since the 1950s. No kidding. Took until about the 1970s before everybody started using it. And nobody's come along with a better model yet. Does this model really tell you what a stock is worth? Of course not. It allows you to do what? Give your own independent estimate of what the value might be, and then you start asking questions. This is really financial statement analysis, but it's really powerful financial statement analysis. I get my own independent estimate of what I think the stock should be selling for. And if my estimate does not agree with the market value, then what I can do is I can ask myself, why not? What does the market think is happening different than I think is happening? Do they think the cash flows are more? Do they think the risk is less? Why do I say risk is less? Interest rates. What are they, guys? What determines an interest rate, a discount rate? What determines that interest rate? 3 factors. What are they? Risk premium. Okay? So we got a risk premium, a factor for risk. What else do we have? The first 2 added together are called what? Seeing as this is a risk premium, what do you think the other half is? How about the risk-free rate? How much I would earn without risk, plus how much I earn for risk. How much I earn without risk, plus how much I earn for the risk, is how much I earn. What do you think of that? Duh, right? True, isn't it? This model is intuitively really strong, okay? Intuitively really strong. And it also works pretty good. That's kind of neat, okay? But really it just gets you a whole bunch of questions you can ask, intelligent ones, right? It doesn't really tell you the value of something. If it really told you the value of something, everything would be valued exactly perfectly because everybody can use this model. So we know exactly what to pay for a stock. Well, no. We have different attitudes about how risky it is. Oh, by the way, what's risk-free composed of? 2 pieces.
Inflation.
Yeah, expected inflation. How much inflation you expect. It's not past inflation, obviously, because we already had the impact of that. It's the future, right? So expected inflation in the future, we guessed at that. Right now, people think that's 1 to 2%, apparently. I base that on what interest rates are right now. Okay? And what else? There hasn't been much inflation in recent years, so yeah, probably 1 to 2%. Okay, and then what was the other piece? What do you call it? Anybody in finance class in here? Not yet. Not you guys. Sometimes it gets. Okay, when you do finance 315, you're going to do this. Okay, what's the deal? It is a real return, a true return, a nominal return. Okay, all those terms are used. So a real return, this is rent of your money. If I knew there was going to be no inflation and I knew there was no risk, I would still want rent on my money. And finance and accounting and econ theoreticians say this is 2 to 3%, right? Well, if you add 1 to 2 to it, what's risk-free right now? 3% on 30-year treasury bonds, something like that. Oh, well, so 3%, 2 plus 1 maybe. On short-term ones, it's more like 3 plus 2, 5%. I mean 4, 4.5 on shorter term ones. Oh, okay. By the way, borrowing from the federal government, or investing with the federal government rather, is about as risk-free an investment as you can have. The U.S. federal government, not every federal government, yours, right? Why is it risk-free? Because we're a rich country, what? They can raise taxes if they want you to get the money. They can print money if they want you to get the money to pay you. You're going to get paid. Or unfortunately, they can invade another country to get the money if they want, right? We've done that in our history too. But you know what? The U.S. government always pays. Always pays. Why is it a big deal when Congress threatens to shut the government down? We always pay. If they shut the government down, we won't pay our international debts. And we'll screw up our credit. Whoa, that's expensive. What happens if you have a mortgage in your house and you don't pay it? Oh, don't go there. Don't go there. Right? Don't eat. Pay your mortgage, right? Sell the house, but pay your mortgage. Yeah. Question? Comment? Change the mind. You did.
I was just, so what kind of investment would be a government investment, like bonds?
Treasury bonds. Yeah, treasury bonds. Mm-hmm. Short-term, long-term. Yeah. Okay. Short-term have higher interest rates right now. Historically, it was the other way around. It's kind of strange. Maybe with really low inflation, it tends to work that way. Okay. So, interesting. But, okay, so the risk-free right now, maybe 3% on 30-year treasury bonds is what we're going to use. So does everybody have any idea what this discount rate would be? And then what we need, all we need really is what? To calculate a present value, what do you need? I know you guys know this, even though you didn't prove it on the quiz. I know you know this. What are the fact pieces you need? Besides interest rate, what else do you need to know? Number of periods. Our number of periods is infinity. Because we're going to have cash flows from the company forever. Okay? So what is this number? We are going to use what to do this? Weighted average cost of capital. Oh, we're getting our discount rate. Okay? That's all we're doing. So this model does. Got it? You're not excited yet? This is cool stuff. You're going to be able to value any company. Right? It's really good. This is a really nice skill. And accountants should have this. That's why we do it here. Not just finance types. Accountants should. Why would we create all this information if you're not going to know how to use it? Come on. Right? What are people going to use it for? They're going to use it to predict the future. So here we're going to have a little example, one section of this class, where we're going to predict the future. Okay? Take out our crystal ball and guess what's going to happen out into the future. Okay? First attempt at that. And that's what you're going to get paid the big bucks for, you guys, is guessing what the future is. Okay? Number of periods, what did I say? This is an infinity sign. I know it's not really, but that's what I meant it to be. Okay? Infinity. What does that mean? Forever. The cash flows are forever. But think about this. How many cash flows do I really have to predict? Let's say I have a 12% discount rate. How many years cash flows really make any difference? Pull out your present value table. Somebody got it? You got their book there with them? Okay? Read us for 1 year with the present value of $1 discounted at 12%. What is that? 1 over 1.12, yeah. 1 over 1.12, 12%. Raised to the first. How much is that? 91 cents? You're in 12% on 90 cents. Is that right?
For what period?
89 cents? What is it? 89 cents. If you invested 89 cents at 12% interest for 1 period, you'd have $1 at the end, right? Okay, go down to 10. What is it for 10 years?
32 cents.
32 cents. How important is your estimate on the first year versus the 10th year? Oh, 3 times as important. You got it? Okay, go down to 20 years. What's the factor? 10 cents. How important is that one? Not much. Now, I can't really predict very well what's going to happen 20 years from now. I can do pretty good 1 year from now, right? 20 years from now is getting hard, but it doesn't matter as much because the present value of those dollars isn't going to be very much at a very high discount rate. Making sense? You guys staying with me? Okay, is there 40 on there? There is, isn't there?
Mm-hmm.
Yeah, what's 40 years?
1 cent.
Who cares? That estimate doesn't matter. So when we say to infinity, how about, 250 years from now? It's worth nothing at a very high discount rate. You guys with me? So the model just says infinity. And what it does is it makes the math simple. Just to get the present value when you're going to infinity, what you need is the future cash flows. And what we're going to do is we're going to treat this as an annuity, right? It's going to be an annuity because it's easier to calculate the present value of an annuity than a whole bunch of lump sums. You guys agree with that? Let's say it's a 100-year annuity. Would you rather do a 100-year annuity, or would you rather do 100 years where the cash flows are different in all 100 years? What do you have to do if they're different in every year? Calculate each one of them independently and add them all up. 100 multiplications and add them all up. Am I right? What do you do if it's a 100-year annuity? One multiplication. Right, guys? That's it, isn't it? You get a payment, it's always the same. You got an interest rate, it's always the same. So what we're going to do is we're going to assume the interest rate stays constant. We're going to assume the cash flows are forever, right? And we're going to calculate the value of an annuity. Now, here's what's really cool about it. All you have to do, instead of adding up all those years' cash flows, or even all those years' present values, present value factors, what it breaks down to, an interest rate to annuity, or to infinity, I'm sorry, an interest rate to infinity. How about, let's pick a number. Let's say our number is 10%, okay? And let's say that my estimated cash flows, which is the annuity payment. You guys with me on that? My estimated cash flows is the annuity payment. I'm assuming they're never going to change for now, okay? They're never going to change. They're always going to be the same. So let's say I made $100,000 this year. That's my cash flows. My net income adjusted to be basically cash flow. Got the idea? Okay? So I've got 10% is my discount rate, and I've got 100,000 estimated cash flows. What do you think the present value of all those future cash flows? This is 100,000 forever, right, guys? 100,000 forever. I'm going to get. That's what I'm saying. By the way, if they made 100,000 this year, what do you think they're going to make next year? I don't know, but what's my best guess? Probably 100. Is it going to be more? I don't know. Is it going to be less? I don't know. That's what we're saying, okay? So I guess my best guess is next year is this year, without any other information so far. We're going to add information to it, okay? What's my best guess of next year's discount rate? It's 10% now. What's my best guess for next year? Our interest rate's going up or down next year. You know what I love? I teach this to executive MBAs, and almost all of them will say, oh, they're going up. And I'll say, okay, really? So when? Oh, I don't know. And I point out to them, I think they'll go up someday too. They can't go down much, almost to zero, right? You know what? If I knew when the interest rates were going to change up or down, and I always knew, and nobody else did, I would capture all the wealth in the world. Because I'm saying, I know which stocks are going to go up and which are going to go down. And nobody else does. I can place bets and win. What if you're playing roulette, and you knew exactly what number is going to come up every time they spin the wheel? How often would you lose? Never. So what's the game? You're guessing, and everybody else is guessing what's going to happen. If you're better at guessing than they are. I mean educated guesses. I don't mean just wild-ass guesses. I mean educated guesses, right? You make educated guesses about what's going to happen in the future, and your guesses are, yours are better than hers, you're going to make a lot more money than she is. Or you're a lot more lucky than she is. Maybe. We can't tell luck from skill in this. That's bizarre too, isn't it? Don't be too proud of yourself if something that you get involved in works out really, really well. It might have happened in spite of you. And don't beat up yourself too much if something you get involved in, the bottom falls out. It might have been much worse if you weren't running it. Politicians do this all the time, right? Because Obama was president, the country is all screwed up. It would have been far better if a Republican were president, right? Prove that one. Either way, right? Are we better off because Obama was president or worse off? I don't know. Neither does anybody else. Of course we don't know. What if Hillary had been president instead? I know all the women want to say it would have been a wonderful world and we'd have peace everywhere and there'd be no crime anymore. This is my wife's view. right? And she's a big Hillary fan. I like to tell her I like Sanders instead, just to jerk her chain. Really fun. You can't possibly be going to vote for him in a primary. Nah. I'm going to vote for, what's his name? Trump. Yeah, for Trump. I'm hoping you'll give me $1 million if I vote for him. Okay, anyway, yeah. All right. So to get this present value, though, here's the cool thing. You're going to love this. This is so easy. And this is the key to it. What I'm going to do is I'm going to take those estimated cash flows, because it's in perpetuity, it's forever, right? I am going to divide it by the interest rate. And that is going to give me the present value at time 0, which is going to be the value of the company. This is going to be the total value of their assets, you guys, the present value of their assets. Got it? Because all the cash flows are earned with all the assets. Make sense? So if this is $100,000 every year forever, that's infinity, right? And this is 10%, how much is the company worth? Total assets, not equity, assets. You got to take the liabilities away now. Okay, how much is that? $1 million. Okay, now mathematically we could prove that. In my PhD program we had to. Mathematically I could prove that 1 over the interest rate is the result. What this 1 over the interest rate, just dividing by the interest rate, is the result of adding up 1 over 1 plus the interest rate for one period, plus 1 over 1 plus the interest rate for 2 periods, 3, 4, 5, 6, to infinity. Right? 1 over 1 plus the interest rate to infinity. All of that collapses to 1 over the interest rate. Isn't that cool? Wow. Wonderful. Any mathematicians in here? People like math? Did you prove that? Yeah, you could. Yeah, you could prove it. You could write a proof to do it. I can't remember what it is, right? No, I wouldn't show you. Still can't. Okay, but, okay? So it's true. It's true. But let me give it to you intuitively. If I invest $1 million at 10% interest forever, how much will I earn every year if I take the cash out every year? I'm not leaving it. It's not compound. I'm taking it out. How much will you earn on $1 million investment invested at 10%? $100,000. It's right, isn't it? Intuitively, you got it? It's true, isn't it? If you had $1 million invested at 10%, say a savings account pays that much, yeah, right. Okay, but say you're sure going to get 10%, for sure going to get 10% every year, and you have $1 million invested. How much did you take out every year without ever touching your $1 million? 100,000. It'll generate 100,000 forever. Got the idea? Oh, so if you didn't know the million, you didn't know this part, but you knew the 100 and you knew the 10%, could you calculate the million? Well, of course you could, right? What investment at 10% gives me 100,000 every year forever? That's the key, you guys. So all this model is going to do is it is going to estimate what? We know the cash flows are to infinity, right? It's forever. What are we going to estimate? We're going to use weighted average cost of capital to estimate the cost of capital. What's capital? What do we mean by capital, everybody? Be careful with this one. Capital is not equity. Capital is everything you have invested. Everything the debt holders have invested and the equity holders have invested. So what is capital? It's all your assets, right? It is not the book value of the assets, of course, that's a historical value. It's the market value of the assets. Everybody good? We're going to do the market value of the assets, which you have invested in. What Weyerhaeuser has invested in all their trees. Yeah, okay. Anyway, what Weyerhaeuser has invested in all their assets is the market value of them, not the book value. They have trees from 1932. Stands of timber they've owned since 1932, from the Great Depression. You think they might be worth a little more now? We care about the market value, right? Because they can sell them at the end of each year, of course, so their investment is really the market value. They have huge gains on that stuff, okay? And they do some really interesting accounting, manipulate their income without violating GAAP. All they have to do is sell old timber, a little bit of it, and their profits go sky high. It costs almost nothing for the timber. Or if their profits are too high, what do they do at the end of the year? Buy new timber and they make almost nothing off of it. Buy new from somebody and sell it and make almost nothing. Did they really make less and make more? No. Does it look like it in their financial statements? Yeah, it's smoothing without cheating. Nothing we can do about it, except know that Weyerhaeuser can do that. And so their earnings are real stable because they're doing that, versus You think the paper and timber industry is real stable? The prices never change? They don't have up and down? Of course they do. All their competitors do. Well, Boise Cascade doesn't either because they're real big and they also own a whole bunch of old stuff. So they don't have as much. At least they have more. Okay. Anyway, Georgia Pacific, Boise Cascade, and warehouses own an awful lot of this country. A lot of this country. Anyway, the timber and the land underneath it a lot of times. Okay. So what we're going to do is we're going to get WACC and we're going to estimated cash flows. We're going to divide WACC into the estimated cash flows, and you will have your estimate of the market value of the assets. Okay. Now remember, everything's market value here. I am an accountant, and I do not care at all about historical costs. Why do I give people historical costs in the balance sheet? Because I don't know what market value is. What do I do when I'm reporting trading securities and available for sale securities? What do we report them at, seeing as they're publicly traded? What do? We report them at market value. And then we show gains and losses, unrealized gains and losses, right? Everybody agree with that? The ones in trading securities hit the income statement as an unrealized gain or loss. The ones that are available for sale go straight into other comprehensive income. But we still adjust, right? Those assets, don't we, for changes in market value. Why don't we do that on land, building, equipment? We can't measure it unless we sell it, right? I hereby decree my house is worth $1 million. My wife and I paid $170,000, I don't know, 10 years ago. It's worth $1 million. What the hell? Why not? I'm not selling it anyway. Is that okay with you guys? Do I even know what my house is worth? No. I know what the tax assessment is. I know what I paid for it. I don't have a clue what it's worth unless I do what? Well, I sort of do, right? Because property values don't go up very fast here. But we've done a few things to it, and it looks a lot better. I put a lot of effort into it, painting and stuff like that. What's it worth? I don't know. Unless we sell it, okay? Imagine all the assets that UPS has. You tell me what they're worth. Okay, so we're not going to do that. Okay, we're not even going to try. And students will say, we'll get an appraisal. I worked for a land developer once. They had $11 million in debt. We needed to have $11 million in assets, so we were solvent. First they were my client, and then I went to work for him as the financial vice president. And so we were having Pricewaterhouse do a review, which is one level of service lower than an audit. Compilations, then reviews, then audits. It's about 1/10 the cost of an audit, but it also has much less assurance, right? But still pretty expensive. But anyway, so we were having them come in to do a review. And they said, well, you can do your financial statements at appraisal value if you want to, but you have to get an appraisal. Okay, so we'll do that. And we said, do you care who we get your appraisal with? Well, don't you have people you use for appraisals? President of the company, land developers. Well, sure, we have relationships with people that, appraisal outfits. And so, well, just get one that you think is reputable and go ahead and get it. So this friend of his comes in, and I'm sitting in a meeting with him. There's the three of us. And he says, well, Larry, what do you need it to be worth? And Larry says, I have $11 million in debt against it. I need it to be worth at least $11 million. He says, does it need to be worth a lot more? Or, no, I don't want to put you out. I don't want to put you on the line or anything. Just slightly overstate. Give it 11-1. Pricewaterhouse took it without challenging. No second appraisal. No third appraisal. No average of 3 appraisals. His good friend, who he did a lot of business with, he could care less what the value was. It's whatever Larry wanted to put in his financial statement. So then, I've been there for just a couple months. Because between teaching gigs, I thought I wasn't going to teach, and I went back. But anyway, so I'm shaking my head like, oh my gosh, I just can't believe this. So then I'm sitting in a meeting with the partner and the manager on the engagement. And they got these financial statements with this appraised value in there, and so we were liquid, right? And then they says, well, Keith, we want you to sign this representation because you're the financial vice president. So the CEO had to sign that this was right, and that I had to sign. And I says, well, I'm not going to sign it because I've only done this for 2 months. You'll have to get the old, she still worked there, the old person who was responsible for the accounting to do it. And they did. And I said, okay, fine, Pricewaterhouse, go. Didn't make any difference anyway, because you know what? The economy recovered and the property values went up, and we sold it for more than $11 million. So I guess with hindsight, it was a good appraisal, huh? No, it was bullshit. If you'd have sold it that day, you might have sold it for $4 million. They didn't bother to check. So, what do you think of appraisal values? I'm based on that. You know what happened in the bubble? You know where the stock market went way down? People bought house after house after house. The appraisal's taken at whatever value the debt is going to be. Whatever you sold it for is what they appraised it. Unbelievable. And then, of course, when somebody tried to sell it a few years later,
So be careful. By the way, does that mean there are no appraisers that do a really good job? Of course not. There are all kinds of them that have integrity, ethics. So, okay, so, yeah. Anyway, it was a fun gig, though, hanging around with those guys. And what wheeler dealer. Jeez. Man, scary. He was involved in the savings of the loan fiasco, too, way back when. Became a millionaire that way. Yeah. So, I wasn't there very long. I just didn't care about money enough, but it was kind of fun and all that for a while. Okay, so let's do this model. Let's give this thing a shot. What does it say, you guys? How are we going to do the interest rate? Weighted average cost of capital equals what? I wish you guys had studied this. Make our lives so much easier. Okay, fine. Go over on page 11. See that whack equals there in the middle of the page? Everybody see it? Page 11, here's numbered page 11. Jill pulls it all together. Okay. Whack equals what? The weight of the debt times cost of the debt. We use K because C in economics is consumption. Okay? Right? So we use K. K is cost. Right? Plus what? Times. Okay. This is intuitively obvious. Right? All I'm saying is this, you guys. The percent you earn on your equity, the percent you earn on your liabilities, right? The weight of the debt. So if I take the percent I'm going to earn, right? Let's say the liabilities I need to earn 10% on, and the equity I need to earn 15% on. Okay? What do I need to earn on my assets? Well, not 25. We're going to have to take the weights times it. Let's say that my assets at market value, right? Let's say my assets are 100, my liabilities are 40, and my equity is 60. At market value, all that's at market value. Let's say I've got that situation. Okay, what are my weights? If this is the cost, 10 and 15%. What's my weights here? I made it easy. 100 into 40 is 40%, right? Because this is 100% of itself. Everybody agree with that? And this one over here is 60%. So obviously the two weights have to add up, don't they? To 100? You know, 100% is the assets. If liabilities at market value are 40%, equity must be 60%. True? Okay? So what I do is I'd say, okay, I need to earn on the liabilities 10%, but only 40% of my assets are financed with liabilities, okay? And then what I would do is I'd say, okay, on the equity, because it's higher risk, I have to earn more, right? You always have to in your equity because they have the risk. They have more risk than debt holders, right? Who gets paid first in bankruptcy? Debt holders, right? Who gets paid last? Equity holders. They're taking more risk. They get more return, okay, more expected return. So if 60% is equity, what would be my weighted average cost of the capital? If the debt cost me 10%, the equity cost me 15%, huh? Got the idea? But 40% of my assets are financed with debt, and 60% is financed with equity. What do you think? Well, this is going to be 4%, which means nothing. It's just the weights. The weight of the debt times the cost of the debt, plus, what's this one going to be? 9%? 60% of 15? Is that right? 9%, isn't it?
Yeah.
Guess what? On the assets, I must earn 13%. 4 plus 9. If I earn 13% on my assets, I'm going to be able to pay the 4 to the debt holders and the 9 to the equity holders, and everybody's happy. Okay? And the value of my stock will not change up or down because it's properly priced if I earn exactly 13% in this little example. So all I'm saying, you guys, is we will calculate the weight of the debt, the cost of the debt, the weight of the equity, the cost of the equity, multiply them together, add them up, and I've got my whack. Okay? Now, how am I going to get the weights? Let's do the weights. It's simply assets equal liabilities plus equity, and I'm going to get the percentage of each. It's just what I did right here. But here's the deal. You have to know what the liabilities and equity and assets are, don't you, in order to get the weights. This is going to be 100%, right? Of course. Okay? And these are going to add up to 100% when we're done. So what I want is the market value. Okay? So I need an estimate of market values. What is the estimate they used in the model? Those of you who read it. For the market value of equity. This is unbelievably easy.
I mean, with your assets.
Well, just the equity. Just the equity. How do we know the market value of the equity? I can find the market value of the equity for any publicly traded company right now.
Price per share, outstanding shares.
Price per share times the outstanding shares. You got it. That's it. That's what it's worth. That's not its book value, of course, right? That's what it's worth. Point in time, little picture, right now, right that moment, right? So could you find that at the end of the year for any company that's publicly traded? Of course you can. Okay, you can estimate it for non-public companies, by the way. Okay? So that's what we do. Is it easier to estimate the market value of General Motors stock than to estimate the market value of their assets? We know what the market value is at any point in time for their stock, don't we? Because it's being traded. Oh. So what you use is something called market cap. That's market capitalization. You know what that is? You just said it. Market capitalization is simply outstanding shares times the market price per share is market capitalization. Yahoo Finance will be printed that. Right? You can go look it up. You can calculate it yourself, I don't care. Right? We're going to use the shares anyway later, if you need them. Okay? And you need the market value per share to compare to your estimate of the market value. So, anyway, yeah. All you're going to do, and this is just intuitive, everybody, let it be. Don't memorize this stuff. By the time you are doing this on quizzes and tests, maybe not the quiz, but on the test and the final, you will not need the formulas. Because it's just, they're simple, and they're obvious. It's just intuitive. It doesn't look like it yet, particularly if you didn't read it. Even if you did read it, it doesn't look like it yet, does it? Okay, wow, what are they doing? Okay, but here's the deal. What are we going to do for our market value of our equity? Gentleman's correct. That's excellent. You read this, or you already knew? Read it. Okay, number of outstanding shares. This makes sense, doesn't it? The shares that are being traded times the market value per share, the most recent one. Okay? When you multiply that together, that is the market capitalization, which is what the market thinks the company's worth right now. Okay? So we just do it. So if the number of shares is 1 million, right? And I'm selling them for $10 per share right now. Say the market value is $10. What's market cap? 10 million, of course, right? And I'd put 10 million here. Okay? My market value of my equity is $10 million. Okay. Everybody got it? So we have a true market value there. Now it changes a little bit on the liability. What we're going to do for the liabilities is, as a proxy for market value, we're going to use book value. You don't have to do it this way. Proxy equals book value. Okay? We don't have to do it that way, but it usually doesn't make any difference if we do. You know what? You could calculate the value of the liabilities. What if they have a whole bunch of bonds? Could you go look up the market price of the bonds and figure out what the market value of those bonds are? Yeah, the market value of the investment in the bonds is the same as the market value of the debt in the bonds, right? So you can look those up. It'd be easy, okay? As interest rates change, the bonds change in value. Could you do the same thing with mortgages? Sure, because you could take the current interest rate and discount all the future cash flows on that mortgage, right? Got the idea? Back to now and get the present value of it? You can do that for a lot of your liabilities. On the current ones, it doesn't make any difference because the current ones are going to be paid real soon, so you don't need to discount. That's sort of the theoretical idea. Same with your current assets, you don't really care, right? Because they're going to be used up real soon. So long-term stuff that would have a different value, okay, based on present values, okay? Based on the time value. So see how we're using present value here? Big time, huh? That's all it is. That's all it is. Okay, so to make this your life really easy, we are just going to use the book value of the liabilities. Just take their total liabilities, right? We'll use their book value as our estimate of the market value. We're still using market value, okay? We're not using some market and some book value, okay? It's our estimate for the book value. And if you want to get fancier, I can show you ways to do that. Really pretty simple. Okay, so let's say what we have, I don't know, let's say we have 5 million in liabilities. Everybody got the idea? I'm making my math easy. What's my total if I add the liabilities plus the assets? And in the world I live in, that's 15 million. How about you guys? Okay, the weights. 15 million divided into itself is 100%. Won't actually do that, but it is. Okay? What's 5 million divided by 15 million? 33 and 1/3. I made my math easy, didn't I? Okay? 33 and 1/3%. Everybody agree? 1/3? 5 million out of 15. And then 10 million? 66 and 2/3. Now, here's the deal. I don't care what those percentages are. They can be a big, they don't have to come out even, right? Like I made this one. It's whatever they are. I don't care how big the equity is. I don't care how big the debt is, right? I just use them, okay? And there's judgment involved in this right from the beginning. It's an art, right? Not a science, really. But that's the computation. So, guess what? I've got my weights. Plug them in. Go a few decimal places, okay? I'm going to take that times the cost of the debt. Okay, I've got to earn that for my shareholders, for my debt holders. Okay, the weight of the equity, and notice the two add up to 100%, right? 33 and 1/3 plus 66 and 2/3 adds up to 100. Okay, have to make sure you do that, of course, or you screwed up your math somehow. All right, so now what would the KD be? Let's do that one. Cost of the debt is what? Okay, what do you give the debt holders? What do they get? They get their money back at the end. But what else do they get? What do they earn? I heard several people say interest. I hope when you guys go to work, you're a little more forceful than that. The guy who interviewed today, we may hire him, but you know what the dean said? I wish he had more oomph. I wanted to go out. Somebody's calling me. 409 area code. They're selling me something, I think. Sorry, I didn't turn off my bike song. It's entertaining and everything. Not too loud. Anyway, Oregon. Hey, the Ducks won. I just slept till 2 in the morning because I was afraid they wouldn't actually pull it off. They won a game. They got the worst defense I've ever seen in my life. That they got their quarterback back, pretty good, and it's pretty impressive. They still tried to lose, even in spite of it. Anyway, next week's Arizona State, they are going to get slaughtered. It's going to be ugly. I know you guys care. But I used to be on the team. I'm kidding, joke. Yeah. Trust me, I'm kidding. Yeah. I've been to their games before. That counts. Okay, anyway. What do they get? They get interest, don't they? But you guys tell me something that's different about interest and dividends. The equity holders are going to get dividends, right? Okay. Debt holders get interest. Tell me something that's real different about it. If you have a small business, you want to loan yourself money instead of investing in the company and saying you can get away with it with the IRS. Why? What happens to your tax return with interest versus dividends? I pay interest or I pay dividends? Oh, come on. Think about this. Anybody in tax class right now?
Interest expense, right off.
Interest expense you can write off in your tax return. Dividends?
No.
No. That's it. So guess what? The government picks up part of your interest. What if I'm in a 40% tax bracket? What happens? I pay 10% interest, and the government picks up 40% of it. Mine's only 6. Got the idea? Every dollar of interest I pay, I save 40 cents in taxes if I'm in a 40% tax bracket, right? 35% federal plus 5 for state. A lot of companies are right around in there. Okay? Right? Unless they went offshore and playing games. Right? Going after those guys. Young Brands is one of them, by the way. Young Brands has been in a 20% tax bracket for a long time, and the federal government's going after them. Suddenly they have a higher tax bracket. But it'd be interesting to see what the tax bracket looks like this time. Suddenly it's normal. Because they're afraid they're going to get penalties and fines, fines and penalties and interest on all the taxes they haven't paid for a whole bunch of years. They made them really profitable not to be paying taxes. And they thought they were following the tax code. The IRS kind of disagrees with them. But it's real interesting, real interesting. So we've had a number of students graduate from here and go to work for Young Brands in the tax department, in their international tax department. You guys work there?
I did work with their international tax department.
They're brilliant people, aren't they? And they're really good at getting their tax bill down. That's what they do. And the government doesn't like what they were doing, right? So, but not just them, lots of companies. They're going after them. They probably won't pay penalties. They'll probably just pay the interest and the tax. Probably, yeah. And they'll settle and not have to pay it all. This is America, right? So anyway, all right. So interest, right? times what? What'd the model say? 1 minus what, guys? Tax rate. Well, of course, the example I just gave you. What if, let's say your interest rate is 10%, okay? And your tax rate is 40%. What portion do you pay? Out of every dollar I pay 60 cents, right? So what's my KD going to be? My cost of debt after tax. Pre-tax, it's 10%. What is it after tax? 60% of 10% is 6%. Everybody good? Do you get that intuitively? Government's going to pick up 40% of it, right? As long as I'm taxable. Oh, by the way, what happens if I start losing money? What's my tax bracket? 0. What's my interest rate now after tax if you have no taxes? 10%. Companies that get in trouble have to pay a lot higher interest just because they don't get the tax deduction anymore. Then, of course, what else happens to you? The bank raises your interest rate, too. On current debt, if it's not locked in long term, then they're raising the interest rate. You can't deduct on a tax return because you're losing money. Bankruptcy real fast, right? So you got to be careful with this stuff. It's what we're going to be doing, you guys. When you're out there working, you're going to keep companies from going bankrupt. Part of making people successful is keeping them from going broke. Like that? Kind of true. Yeah, I had a lot of clients who were on the edge of going broke, and we really worked hard to try and save them. Right? And sometimes we were successful, and sometimes we helped them liquidate. Right? Yeah. Anything what you could pull off. Okay, so let's say that was 6% then. You just plug it in. What I recommend is you make one of these a decimal and the other a percent. I don't care which one you do. But that way you only have, if you don't have a whole bunch of decimals going across the page, really works good. Okay? All right, let's do this one. So this one, KD, is right here, right? Okay? What's KE? How do you do that? Cost of equity, KE. What do you use? Somebody who read it, tell us what model we use.
Expected return.
Yeah, it's the expected return. What stockholders should expect to return. What model do we use for that? What do we call that thing? This is weighted average cost of capital and capital asset pricing model. Okay, that expected return at the bottom of page 11, the last formula there, right? There's the interest one, by the way. See that? Cost of debt? Okay, it's right there. This page has it all on it. Read the rest, though. What's the expected return of the cost of the equity? KE. It's cap in. We're going to use the capital asset pricing model. Okay? This is the famous model they came up with. Right? All right. What do we use? What's the formula? Risk-free. You know what risk-free is? I just talked about it, didn't I? Risk-free is what? Real return, true return, nominal return, right? Plus expected inflation. Okay? So that's what that's going to be. So we got risk-free. We got risk-free. It's the return that you would get on a risk-free investment. Why can't I write an F all of a sudden? It equals risk-free. Okay? Still can't. Okay, anyway, won't go down. Wait a minute, my nerves. Okay. Risk-free, and then what? Plus. Beta. Times risk premium. And it's the market risk premium. Okay. Risk-free is an interest rate. Risk-free is an interest rate. Risk premiums, an interest rate. They're both interest rates, okay? Risk-free is what you could return on a risk-free investment. Risk premium is the additional return the market gets, right? The market as a whole gets at any point in time, okay? Stock market as a whole. Or really, it's supposed to be every investment in the world, right? We'll use the stock market typically. S&P 500 or something, right? Okay. That's what it is, okay? So what is this thing? If this is the risk premium for the market as a whole, beta times risk premium is what? The risk premium for a particular company, for a particular firm. Okay. So what's beta? is a proxy for the riskiness of your particular company. Really what it is the covariance of your returns for your company, right? The covariance of their returns, how much is fluctuating up and down over time, right? The covariance of those returns with the returns on the market as a whole, okay? So let's say we've got this. We're going to maybe demonstrate this a little bit. So for beta, and we use a Greek B for beta, right? Betas, okay? I can't do them right. It looks like that kind of, okay? Use that. Okay, what the beta looks like is something like this, okay? So let's say that the market is doing this. So these are dollars over time, okay? Time goes by, right? And the market is doing this sort of thing, right? It's going basically up, which it tends to do over time. Let's say it did that over time. You're looking at a window, right? I left out 8 years ago when the bottom fell out, didn't I? Okay, but anyway, so it goes up and down, goes up and down, right? It does, okay? But generally up over time, okay? So if that's the market return, what if your stock is doing this sort of thing? So this is the market. So it's their returns over time, how much you're earning on the market as a whole over time, okay? Variation of the returns, variance of the returns, okay? And this is company A. What would you say about the riskiness of that company? What if you want to sell when it's down here? You're going to lose your shirt, right? What if you want to sell when you're up here? You're going to really make a lot of money. Got the idea? But we equate that variation, that variability up and down, we think that's a proxy for risk. I kind of agree with that. If you invest in something that's bouncing all over the place and you have to sell it and it's down, it's over, right? Or what's the risk of bankruptcy if they go all the way down? It's over, right? If they go down negative, you know, and have big enough losses, they might go broke. So you're kind of rolling the dice with a company that looks like that. That would be a very, very high beta, because the covariation of this return with that market return is going to be way over 1, right? So this might be a beta equals 3 or something, 3.0. Might be worse than that the way I drew that, okay? Very risky, okay? A high beta. What if, though, your company is more like this? It goes just down through here, right? See that one? Company B. I should use different colors. I can do that here, too. Okay? This is company B. It's just that line that, you know, it has less variability. When the market goes up, it doesn't go up quite as much. When the market goes down, it doesn't go down quite as much. It's just real stable. Utility companies used to be this, right? Okay? Right? There are still some companies that do this. You know, they're just going to earn, right? Regulated industries do this a lot. Okay? Right? The more regulated you are, the more your earnings just stay kind of stable, right? You can't raise your price a lot. You don't have any incentive to lower your prices, right? You're regulated. You know, monopolies perhaps, or oligopoly type environment. Okay? So there are some industries that are really, really stable. They would have a beta less than 1. Okay? So these that are up here have a beta greater than 1. These that are down here, you know, more stable than the market as a whole, that would have a beta maybe of 0.5, right? So if you see a beta less than 1, it means they're less risky than the market, or we think they're less risky than the market. If you see a beta of 1.0, what do you think? They have the same risk level as the market. What if their beta's 2? They're twice as risky as the market. 3 times as risky. Got it? So this 0.5 would be half as risky. Everybody good? Okay, so let's go back. And let's talk about how to calculate this CAPM here. Okay? What would you do? Well, first, the beta is their covariance of returns, right? By the way, you can look up the betas on Yahoo Finance or MS Finance. You look it up. Yahoo or MS, whatever. Any of the servers, right? Value line, just pay for that one. That's more recent data. Okay? So yeah. By the way, when you look them up on different sites, you might get different numbers. The reason is they might be using a different period of time. So if they use a real short period of time, they might have a different beta than if they use a longer period of time. Make sense? Because, you know, it's a picture you're looking at. And sometimes they're laughable. They're so far apart. So you might want to look at several of them. Okay? Make sense? All right. What are we going to use for risk-free? What did I suggest in the paper?
30-year slot.
30-year T-bond. By the way, the old dean at U of L was a finance professor. He wrote a really good book, widely accepted. I think it was a 5-year Treasury bill. I think he's wrong. That's why this paper says 30-year T-bond. Dan agrees with me, Dan Bauer, David Collins, who wrote the paper with our names on it, right? Yeah. No difference of opinion. He thinks it's your investment horizon. I think it's forever. Because the cash flows are forever. The model says the cash flows are forever. I think you should have used the longest discount rate you can, right? So, but it changes the valuation dramatically if you use 5 years instead of 30 years. So you need to know if you're looking at somebody else's calculations, you need to know what they did, right? It's going to change everything, right? Different assumption, okay? There's nothing wrong. He can do whatever he wants, right? Obviously, okay? So there's people all over the world that are learning 5 years. You guys have 30 years. I don't know. Which one's right? Neither. We're just guessing anyway, okay? All right. So that's easy to find, isn't it? We look that up out there on Yahoo Finance too. Okay, big deal. Okay, and then the risk premium. What is that? What is the risk premium? What's the formula for that one? Anybody know?
Market return less risk free.
Return on the market minus risk free. Excellent. Okay, what does that mean? I got risk free over here, and then I got risk free over here. Oh, the market's beta is 1.0. So look at this for the market. If the return on the market, let's say the return on the market is 12%. It's been 12 to 13% over the last 30, 40 years, okay? If the return on the market is 12%, okay, what is it composed of? So that's now cap M for the market is 12%, okay? Return on the market, okay? What they would expect, what you expect to earn on the market. That's still risk-free plus beta times the risk premium. But what's the beta for the market? It standardizes what? Because we're comparing, when we do the covariation with the market, we're standardizing as what? What? 1.0, make it a straight line. Oh, so of course the return on the market is what? The risk-free plus the risk premium for the market, okay? So what's the risk-free? Let's say the 30-year Treasury bond, let's say it's 3%. Probably what it is about now. Okay, 1 second, okay? So if this were 3%, what's the risk premium for the market? You know, if the market earns 12 and the risk-free is 3, it's too big now, okay? But what's the risk premium going to be? 9%. Okay? Would everybody agree that the return on the market has to be the risk-free, or the risk premium, rather, has to be the return on the market less the risk-free? All right? Isn't it true that the risk-free plus the return, or the risk-free plus the risk premium is the return on the market? And if the beta of the market is 1, well, it just works, doesn't it? Why do we bother with this? It's silly in this calculation, but why do we bother with it? Because for every company, their beta is not 1.0. So what we're saying is, look, you are going to earn the 3%, plus you're going to earn your risk premium. So now let's try a beta of 2. What if your beta is 2? What would be the deal? Let's say risk-free is 3, okay? So I'm going for cap M, which is the return for that particular company, expected return, right? It'll be risk-free if we say the risk-free is 30. It'll be the risk-free, 3%, I'm sorry. If the risk-free is 3%, what are we saying? You're going to get 3% without taking any risk. Do you get any sort of additional return because you're a risky company on the risk-free? Everybody gets the risk-free. What is that? Rent of your money plus expected inflation, right? That's what that is, okay? So what we're going to do is we are going to add the risk premium to that. So let's say in my ridiculous answer it's 9%. I think that's too big, okay? But it's 9%, say, okay? So what am I going to add? 9% times what, everybody? The beta of the company. Let's say this company has a 2.0 beta. What happens? We have double the risk premium because we have double the risk. So instead of having a risk premium of 9, like the market does, where the beta is 1, what do they have? 18. So you'd add 18 plus 3, and what would be their expected return? What if the beta is 3? It'd be 3 times 9 is 27 plus 3 is 30%. Can you see how startup companies pay really high returns? If they pan out? Yeah, they're risky. What if our beta is 0.5? Let's do a beta of 0.5. What do you get, guys? 7.5%. Low risk company, high risk company. Got it? That's what they should earn on their equity, okay? On their equity. Are we good? Really, the risk-free, what do we say in the paper? I shouldn't use 9. Risk-free in the paper was what? Between 5 and 7, we said? I said it should have been 5 to 8. I got voted down by the other two. 8's a little much, Keith. I don't know. It's been doing that. Okay? But over time, yeah. Probably 6, 7. I think 6 to 8 maybe better. 5 is low. Right? You're pessimistic. Okay? By the way, how do you know? You know what this number is here? This return on the market of here, that 12%? We're going to take the return on the market less the risk-free, right, to get the market risk premium. So I'm going to do this. I'm going to have the return on the market. If I think the return on the market, let's use a more realistic number. Let's say I think the return on the market is going to be 10% forever, at least in the foreseeable future, right? That equals what? Risk-free plus the risk premium. Way you could write it, okay? So if the risk-free is 3%, what's the risk premium, everybody? Which is probably realistic for right now. 7%, isn't it? Okay? That's where that comes from. Okay? Everybody got it? On quizzes and tests, I will either give you the return on the market or I will give you the risk premium. Right? Be careful. They're different things, aren't they? Real different things. Okay? So be careful which one did I tell you that we had. Well, where do I get the return on the market? Really little. What do you think is going to happen for the rest of the year in the market? What are they going to earn? I think we might continue to earn what we did for the last 30 years, 40 years, between 12 and 13%. When we took the big dip in the market, went to 1/2, all the returns went way down there. We said, oh, the world's changed. Before that big dip, everybody thought, no, the market is going to earn more like 10% forever, risk premium. Then it goes down to 5%. Give me a break. Forever didn't change from 10 to 5. 10 was way too high, 5 is maybe too low. Right? So right now, people are, as low as risk-free is, they're saying, well, maybe it's 5 plus the 3, risk premium of 5 plus 3 risk-free, and the market's going to earn only 8%. The market's doing far better than 8% in recent history. Last 7 years. Why do they think it's going to be that low? So anyway, you can use whatever you want, right? So when you're valuing Yum and Target, you have to decide which ones you want to use. Okay? On problems I give you, I'll probably give you one, right? But give you something to use as a frame of reference. There's not a right number. It's not a wrong number. It's what you think is going to happen in the future. Got it? What do you think it's going to be? And when you determine what the return on the market is, forever, and you subtract the risk-free from it, you have decided what the risk premium is forever. Got it? The other way you can go is you can add the risk premium to the risk-free and get the return on the market. You do it both ways, of course. Okay? All right, guys? So this is easy so far, isn't it? No, not really. But it will be after you do it a few times. Okay, so where were we? We had the weight of the debt, the weight of the equity, we had KD, and what we just determined KE was. Which one should we use? Let's assume our beta is 2. What number did we come up with? When the beta was 2, what did we come up with, you guys? 21%. 21%. So let's use the 21%, okay. Wow. You mean the debt only costs us 6% and the equity costs us 21%? Yeah. If people think we're that risky, which is kind of weird with so much equity compared to debt, but maybe, okay? Depends what products we're into, what we're doing, okay? All right, so now what? I think you should borrow more money, personally. Right? That's a lot of insights you get out of this thing, huh? How much money are you willing to borrow at 6% if you can avoid paying shareholders 21? Maybe I borrow money and buy out some of my shareholders, huh? Get rid of them. Is that going to increase the riskiness of my business? Yes. My debt goes up, my equity goes down, I'm more risky, huh? Which is going to maybe drive my interest rate up. So anytime you change anything in the debt to equity structure, the capital structure we call it, you change everything, right? And this model will handle it, right? You just recalculate it with the new stuff, right? What's going to happen? So anyway, let's calculate this. What is the WACC for this company? 0.333 times 6%. What is that? Now these numbers mean nothing, you guys. We're just doing it for computation. The weight of the debt times the cost of the debt is not really going to be anything other than just a factor, okay? What's going to matter is the WACC we're going to get over here. So what's 1/3 of 6%? I think it's 2%, is it? Okay. What is 2/3 of 21%? Man, I made the math work out easy, didn't I? Didn't do that on purpose. Did. That's 14%, isn't it? What do you have to earn on your assets? To keep both the debt holders happy and to keep the equity holders happy, right? The equity holders get earned 21%. The debt holders get 10, but then the government picks up 4% of it because you're in a 40% tax bracket. Got the picture? Is this making sense? Those of you who read it, is this really making things more clear? It's like, oh yeah, it kind of makes some sense. I'm just trying to do it common sense here, okay? And those of you who didn't read it, oh well, right? Kind of. Come to the meeting prepared, gang. Okay, anyway, so what do we got? 16%? Okay. How am I going to value my assets? I'm going to take my estimated cash flows and divide it by what? 0.16. That's it. Okay? No kidding. Okay, so let's get estimated cash flows. I now know my WACC. Remember the 16%. Okay? Let's get my estimated cash flows. How am I going to get my estimated cash flows, gang? What do they do for estimated cash flows? Projected annual cash flows at the top. Now this is a finance approach. We'll use more of an accounting approach too, but it's the same thing. What you do is you estimate the income from operations before tax. And what we want here is not really the income from operations before tax. What we want is the normal income from operations before tax. It's what do you think is going to continue forever, right? What do you think is going to be normal for this company, for their income before taxes, right? Okay, we'll talk more about that next time. Okay, and then what we'll do is we'll take that times what? 1 minus the same tax rate we used doing the interest, huh? Whatever it is. So what I say, it was 40%? So this would be 1 minus 0.40. Remember we did the interest, I used 40%, so it'd be the same one, okay? By the way, where do you get that interest rate? You can look up at the notes of the financial statement, see what it approximately is. You can take their interest expense and divide it by their average debt. That's not bad. I like that approach. That's what we suggested. Okay? You do it that way. Okay, so work this little sample problem for next time. Okay? And value the two companies. Okay, so let's say that my income before, income from operations before tax is $1 million a year. Okay? I've got $1 million here. Okay? What do I have so far? I got 1 million times 60, right? Because the government's going to take 40% of my million. Everybody good? Okay, but then what else did they do to this formula? What else did we do to the formula? What did we add then?
Depreciation.
Plus depreciation. And this is depreciation expense, not accumulated depreciation. Just like you're doing a cash flow statement, kind of. Now here's the deal. This 1 million has the depreciation out of it. So let's say I had 200,000 of depreciation. How much taxes did I save because of that depreciation expense? If I had 200,000, let's make the depreciation expense be 200,000. Okay? So that's what we do, we'd add it. But how much taxes did I save? My income would have been 1,200,000 if I hadn't taken the depreciation out, right? I'm in a 40% tax bracket. How much did that save me in taxes? 200,000 in depreciation. 80,000, 40% of it, right guys? So if I'd save 80,000, I now have more cash, right? Because I saved that much taxes. But how much cash did I spend for my depreciation? How much cash this year did I spend for depreciation? It's not debit, depreciation, expense, and credit cash. What is it? Debit, depreciation, expense, and credit accumulated depreciation. When do you pay for the depreciation? Well, you can think of it as when I buy the asset, which is investing in it, or when I replace it, which is investing in a new one, right? There's no cash flow for depreciation, is there? But there's a tax benefit. So what we do is we leave the depreciation in when we calculate their income, right, before tax. So we get the tax benefit of that depreciation, right? In this case, 80,000, 40% of the 200. And then we add the 200, right? Because it wasn't a cash item. So what would I have for my estimated cash flows here? This is a simple calculation, isn't it? Although figuring out which number you want to use from their income statement here can be real hard. You want all the revenues that are going to continue into the future and gains that are going to continue in the future. You only want expenses that are going to continue in the future and losses that will continue. So you have to decide which ones are going to continue. And finance class, you know what they're going to do? They'll just grab the number, write it down. No. You guys are accountants too. We try to figure out what's really going on, okay? And that's why our finance program's better than other schools. Because you get to learn accounting first, and then you layer this finance stuff on. It's fantastic, right? I can really read a financial statement, and I get a really good estimate of the expected cash flows instead of just calculating the estimate. What is this number, guys? It's 600 plus 200, isn't it? It's just 800,000. Okay, now we can value the assets. Let's value the assets. What would we do? What do we do to value the assets, everybody? This is really, really simple. They do a, somewhere she got it. Here's an example of it. Back on no growth in cash flows on page 14, right? Exactly, and this is the valuation of that particular company. What would we do? All you're going to do, this is really simple. All you're going to do is you're going to take your estimated cash flows and you're going to divide it by WACC. What did I say really early on you were going to do to calculate the present value of a company's assets? You were going to take their future cash flows, right? The annuity. We're expecting this cash flow forever, right? If we have no growth. No growth means no increase or decrease, because you have negative growth too, right? No change in cash flows, okay? And you're going to divide it by your WACC, right? We're going to assume that's our cost of capital. Well, what do we have for estimated cash flows? 800,000. What do we have for WACC, everybody? What was that number? 16%. Oh, are you kidding? That's it. You know what? This is the estimated market value. Our independent estimated market value of the assets. Okay? That's it. Just like that. Okay? What amount of asset would you have that when you earn 16% over here, right, yields you 800,000? Well, divide 800,000 times 0.16 and you'll get it. How much is that? 5 million even? We hereby decree the assets are worth $5 million. If they are generating you 800,000 a year and you're earning 16%, that's true, isn't it? What do you want to subtract from that so that I get the estimated market value of the liability, or the equity rather? I gave it away. Jeez. Guess what you subtract from assets to get it to get equity? To get my estimated market value of the equity, what are you going to want to subtract from the assets? Let me yeah. What do you think? Did you guys know that the assets less the liabilities is the equity? What if you took your estimated market value of the assets you now have and you subtract your estimated market value of the liabilities from it? But you know what? We already had the estimated market value of the liabilities, didn't we? What did we estimate that at? Way back when. What did we estimate that at? It's the total liability. Our proxy was the book value of the liabilities. How much was that? It's down here, wasn't it? What did I have? 5 million? Uh-oh, give it my example. That didn't happen often. That's terrible. Okay, I don't like this company anymore. I didn't know if I was going to like it at all. What? That's an amazing coincidence. What's the equity worth? No. Oh, crap. I didn't have enough cash flows. We have just enough cash flows to do what? Pay the debt, or lose and break even. We're dead meat. Well, you could find out a company's worthless, couldn't you? Could you have a negative equity? Yes. Okay. Jeez, I can't believe I did that. Okay, the cash flows, I hereby decree, let's do one more. Let's say it was $1,500,000. Let's value this business. Still going to be crummy. Okay, what would we have if that was 1,000,005? We'd have 1,000,005 times 60%, which is 900, right, guys? Plus 200 is what? 1,000,001. So if I had 1,000,001 here, what would I have? I want to do this so I can show you one more thing. If I had $1,100,000 there, and I divide that by 0.16, what do I get?
6,875,000.
So at least I have a positive equity. That's funny. Came up exact. Okay? Without trying. So what would my equity be? I still have 5 million liabilities. My equity would be what? 1,875. One more thing you want to do, and next time we'll do growth, right? This is no growth. What would we do? To find out what the market value is per share. This is the total market value of the equity. It's our estimate of market cap, right? What would you do?
Divided by outstanding shares.
Yeah, that's it. And did we use those already? Yes. Right? What were our outstanding shares? What do I have back there? Is it 1,000,000? It's 1,000,000. So what's this stock worth right now then? At first it was worth 0. What's it? 1,000,000 shares. Okay? 1,000,000 outstanding shares. So what would it be per share? $1.87. $1.87.5 per share. Everybody agree with that? True, isn't it? That's my estimate of the market value per share. By the way, what did the market think it was? What did I have way back then? I said it had I said there were 1,000,000 shares at $10. If the market thinks it's worth $10, what must be wrong with the way I did this? The answer is maybe nothing. Maybe, see, we valued it at less than $2 a share, right? If that were the income, right? And the market's saying they're $10 a share, what might the market think is going to happen? Either they think they have a different estimate of cash flows, or they have a different estimate of liabilities, or they have a different estimate of market cap, which is highly unlikely, or they have a different estimate of what? Risk of the business. So they have a different CAPM, which would give them a different WACC. You got the idea? So any of those estimates that we've had, maybe they could be different. But what's the biggest thing that could probably happen? Maybe the market thinks cash flows are not going to stay the same forever. What might they think they're going to do? Grow. And that would be growth. And then we add growth to the model. We can calculate how much growth they must think it is. We'll do that next time. So that's just what we'll do. So, see you guys. Read it, please. Study. Oh, did you take an email? Send me an email. Yeah, I forgot. I apologize. But I don't apologize. It's fresh. Email me. I can. How much was it? No. You could have got 5, 12, 15 for next card. That's a
Yeah, no, I
huge rich, right?
Because I like only the like Uber in like the job
You're helping.
I like I literally searched the whole job